All right. Hey, everybody. Lindsay Davis here with Spartan Invest, and I am pleased to welcome Caeli with Ridge Lending. And Spartan and Ridge have been doing business for a really long time, and so she's here today to just talk about, honestly, all things lending, how the COVID-19 pandemic has affected owner-occupants purchases, investor purchases, all of the changes that we've seen over the last, 4 weeks, and maybe speculate a little bit on how this is going to play out moving forward. So welcome. Thank you so much.
Thanks, Lindsay. I'm very happy to be here. Thanks for having me. Okay, so for those, I'll just kind of give you all a quick background for those that maybe don't know who we are, Ridge or myself. We are actually a second generation company that focuses in that non-owner occupied side of lending. While the VA and FHA owner occupied were capable of all of it, our special skill sets have always really been reserved for the investor and their lending needs. We're licensed all over the country, so we've got a broad footprint. I've been doing this for over 20 years, but I think what I would want to share with everybody that probably sets us apart from the rest is that I'm a fellow real estate investor. I've held many, dozens and dozens and dozens of properties all over the country over my career. So hopefully that unique perspective adds some credibility. So that's just a quick 30,000 foot view. We focus on education, among other things. So if there's a real value add, I would tell people the language of finance when we're talking about real estate investing tends to be a little bit overwhelming, right, for folks, sometimes even intimidating, but it's the leverage that gives us the greatest rate of return on our investment. So I'm always saying that having some of those baseline definitions and understanding how to optimize debt to income ratio and credit scores and all of that is just so important to maximizing your investments, right? Your passive real estate investments. So that's kind of what we're known for. Anyway, I will get right into it. So Lindsay, we're going to talk about the mortgage markets and how it related to COVID and everything that's happened from the onset to now and where we think we're going to go, right?
Right.
Okay. So feel free to stop me at any point if you've got questions or something comes up, obviously. But I might just begin by explaining something real quick. A lot of times there's confusion between conventional financing and then government loans. Okay, so to clarify that, the Govy loans is what we call them. Those are going to be your VA and your FHA and your USDA. The conventional loans are what we call agency loans. That's Fannie Mae and Freddie Mac. As that relates to investors, the Fannie Mae, the Freddie Mac, the conventional or agency, those are where those loans go. They fall into Fannie Freddie. They do not get purchased or secured by the Govy loans. Those are for owner occupied only. Okay, so just kind of get that out of the way. So let me just kind of start from the beginning. February 20th. Most people that listen to this will remember that date as the day that they saw that stock market just nosedive, right? We saw that huge downturn in the stock market. And that's sort of where the precipice was. That's sort of where things began. From there, we saw the bond market, mortgage bond market prices go up. And when that happens, interest rates go down. Well, they went up so fast and rates came down so fast that as a result, we saw a massive, just a tidal wave of new refi applications for obvious reasons. Everybody saw these low rates. They wanted to get into refinance. Well, it was such a massive amount of applications. I'll give you a quick example. They're estimating that we saw in I think it was a little under 30 days, just over $1 trillion worth of mortgage applications. I mean, and that's a big number. If you think about it in context, annually in this country, combination of refinance and purchase, we'll see anywhere from 3 to 4 trillion in a year. So obviously it's going to make sense to everybody that the capacity issues alone in dealing with that much volume all at once in such a small period of time, it wreaked havoc in the mortgage industry. So as a result, they had to slow the freight train a little bit, and they artificially inflated interest rates to start with, just to kind of get things back into check and get some of those pipelines moving and liquidity back in, etc. Well, from then to now, it was a very small period of time that those rates were that low. I would give it 3, 4, 5 days, a week max, that rates were in that low range, and then they artificially inflated, and that's kind of where they've stayed. Now, The reason that they've stayed there is when we start getting into all the COVID conversations. And a lot has been talked about, a lot of changes in our industry. There's been some casualties actually as a result of, and I won't take the listeners too far down the rabbit hole of secondary markets and margin calls and that kind of thing, but to try and simplify it, because of the fears of what's going on in the secondary markets, the unemployment claims, you've got higher risk. We have seen some major differences and major changes to how the securitization and the servicing rights of these mortgages are going to operate. Some of the bigger casualties are non-QM. QM stands for qualified mortgage. Fannie Mae, Freddie Mac, and conventional, those are or Govy, those are defined as qualified mortgages, okay? This came back with Dodd-Frank 10 years ago. Everything outside of that box of underwriting guidelines is deemed non-QM. So this would be for an investor perhaps that had maxed out their 10 conventional loans and they still wanted to leverage at 30-year fixed rates. That would be non-QM. It's a pretty diverse product line, not just for investors, but for everybody. Well, our first casualty of all of this, non-QM gone, disappeared, zero, no non-QM in the industry. That was casualty number one. The second one that we saw was jumbo loans, and that started to dry up pretty quick. And as far as I can tell, as of today, there really isn't any funding for jumbo loans as defined by loan amounts over 765,000 and change. I think 765,250. Those are also gone. Now, the other casualties have been qualifying, and there's some good news in this actually, at least for us investors, which generally speaking, if you've been around long enough, you know that we're usually the first piece to get hit the hardest. The investor loans usually are deemed the most risky, and we're the ones that kind of get the short end of the stick. So the Govy loans, beyond the two that I already mentioned, have really taken some big hits because those VA, FHA loans, those are ones that typically will have the lower credit score borrower that are yielding or leveraging much higher, right? 95%, 96.5% on the FHA loan, 100% for USDA loans. So as a result, those loans and all of the unemployment claims and everything else that's been happening, the servicing runoffs, the buybacks, those are all kind of a part of this. The qualifying matrix for those are really increasing. They're really enhancing those. As an example, 580 middle credit score could get an FHA loan up until about a month ago. You need about a 660 to a 680 to get one of those loans. They're increasing the reserve requirement for those loans. Debt to income ratios need to be lower. So they're getting hit pretty hard. Yeah.
Yeah. So real quick, so just kind of big picture from an owner-occupant standpoint. Now I know you and I, we work in the investor space, and trust me, we preach, hey, but purchase investment properties with leverage funds because it's someone else's money, your rate of return, et cetera, all the things that you touched on. But from the overall owner-occupant and just the big picture of the market in general, how many owner-occupant properties are purchased with those type of loans that are no longer
you know what I'm saying? Harder to qualify for,
right?
The percentage. That's a good question, actually. So if you look at the entire nation and annually, on average, less than 3% of fundings for either agency or government loans are for non-owner occupied. Everything else is owner occupied. So in that pool, the difference between Fannie, Freddie, and then those Govy loans, I would say the government loans, you know, to be honest with you, I'm going to just pull out a statistic, and I don't really know the answer to that. I would say the Govy loans are at least half, if I had to guess, of what the owner occupied, the remaining owner occupied of that pool, but the vast majority obviously is owner occupied. But of that owner occupied, 50% is Govy. I should look that up.
Yeah, and I was just curious from like the whole standpoint of the market in general. But yeah, like I said, you and I, we stay in that investor space. So sorry, continue.
That's okay. So that silver lining that I was mentioning is that because those Govy loans aren't for investors anyway, and going back 10 years, people remember the term Dodd-Frank, right? After the mortgage and the housing crash that we saw in 08, 09, investors got hit really hard. We went from, and granted, some of the practices were completely irresponsible. I fully acknowledge and agree to that. We didn't do any of those things. Rich didn't do those things, but the knee-jerk reaction to what caused that that crash, that mortgage and housing crash, was that investors specifically went from no limit to how many finance properties they had. LTVs were much higher. I mean, people were getting 5% down on a rental property, 10% down on a rental property. Credit score requirements, all of those things were very different. Post the 08-09 crash, it was immediately, the max was 4 finance properties. I mean, like a light switch. They've raised it since to 10. 20% down minimum, single family. Credit score requirements, 680 and above. All these extra reserves that we have to show to get one of these conventional investor loans closed. So the nice thing is that we now seem to be in that agency space, the Fannie Freddie. We are the least risky right now. We have been operating this way for the last 10 years, putting all of that 20% down, having these extra reserves. So as far as the mortgage industry goes, on a 30-year fixed basis in the secondary market, investors rates are still a little bit inflated, and I'll get to that in a second, but for qualifying purposes, we're doing really well. Nothing super substantial has changed for our purposes. The forbearance may be something else that we should talk about in relation to guidelines and how that might change things. But let me quickly touch on interest rates, because I think that's a lot of people, that's their primary focus, right? Interest rates. They want to know where interest rates are. I get that question all day long. So rates are higher than they were before all this happened. I would say that we're probably in the high 4s, low 5s. My comment to that is when people say, oh, those are high rates, I'm going to respectfully disagree. And maybe I've been around long enough, and a lot of people listening to this will probably agree that we have short memories. And I'm guilty of this too sometimes. But to be fair, a 5% interest rate on a 30-year fixed mortgage, 30-year fixed, which by the way, guys, we're one of 2 countries on the planet that even offers a 30-year fixed mortgage. So there's that, keeping our cash flows high and our payments low. 5% is still among the lowest that we've seen historically for an investment property. So that's my 2 cents on rates, and I'll shut up about that. I do think that we'll start to see some improvements, but most investors are looking in that 80 to 150 range price point. The improvement from where it is today to where I think it'll go, it might only be dollars a month. So if you're hedging and thinking you're going to wait for rates to come down over 20 bucks, I think that you're losing out on opportunities. That's my 2 cents. Okay, done.
Yeah, we do get the question a lot, like how low do you think it's going to drop? Yeah. Should I go ahead? Should I wait? Yeah. You know, and it's when you're talking about the possibility of $20 a month, it doesn't make sense. Yeah,
the delay.
Doesn't really.
So just real quickly, and then Lindsay, any questions that you have that maybe haven't been answered? The forbearance. I think this is a really important topic, especially for investors, and I'm trying to get some clarity on some of the renters and eviction things. I think it's going to be state by state. I think the feds have kind of blanketed. There's a stay for eviction, but I'm getting differing information. It's a little bit disconnected. I'll explain in a second. But the forbearance, first of all, and these are personal opinions, okay? I feel like the way that it was communicated to the public was a little bit irresponsible, maybe even reckless, okay? They're making it sound like it's go to lunch free money, when in fact, forbearance is not forgiveness. Let's be clear about that. It is a deferment of those mortgage payments. So most of the servicers, and this is what I'm hearing so far, there's going to be several ways in which the individual is going to be required to repay any months of forbearance they elected to take advantage of, okay? And before I get into that, let me just be clear. I may repeat myself. The forbearance is for people that genuinely cannot make that mortgage payment, right? They've lost their job. The problem I really have with this is that there's no hardship required. They don't have to, they don't have to prove hardship at all. They have to verbally attest that they've been affected by COVID and they're eligible for forbearance. And I think that that's wrong. I think that's giving the wrong message. So the ways in which we are seeing that the forbearance has to be repaid, the most common so far, let's say that you took 3 months of forbearance, you didn't make a mortgage payment, okay? By fourth month, you've got that mortgage payment due and a balloon of the full 3 months that you've missed. So now you've got 4 months of mortgage payments due all at once, which in my mind completely defeats the purpose to begin with. The fact that that's how some of these services are electing to do this. So be very, very clear. If you decide that this is something you absolutely need, call the servicer and be very clear about how the repayment's going to work. So that seems to be the most common. I have heard on occasion that some are just adding it to the back of the loan, right? The principal loan when you go to sell or refinance. I'm not hearing too many are doing that. Some are putting it as a second lien mortgage, the amount of forbearance or mortgage payments that you missed. And while others are taking it and modifying the mortgage over the remaining term of your loan. So let's say you had $5,000 in deferment or forbearance, they're going to take that and add it on to your payment over a year or 2 years or whatever, something like that. But everybody's going to be different, so be very, very clear. The other thing, and this may be most important to you investors, the feds have announced that there will not be any mortgage lates, right? Your credit score will not be affected, which is true. They will not report you as late, so your score will remain intact. However, it will very clearly say, I've already seen it myself, it'll very clearly say on the credit report for that mortgage, forbearance. I can tell you that 3 of the biggest players in our industry have already started to rewrite their guidelines that for any individual that was in a forbearance is not eligible for conventional financing for up to 24 months after the end of the forbearance. So be real clear about why and how you want to do this. Yeah.
Right. That is huge, especially for your consistent real estate investor that's constantly trying to acquire and build their portfolio. This should definitely be your last ditch. Again, my opinion, but this should be the last ditch effort that you try to take advantage of when paying. Hopefully you're still able to dip in your reserve, because at the end of the day, this is really no different than any other risk with owning investment real estate. And you could go a few months with an eviction, or like we had trees fall in houses. And so those are going to, with the tornadoes that came through Alabama. So those are going to be additional costs that will hurt your cash flow. So if you take advantage of that forbearance, then yes, it'll hurt your ability to constantly purchase. So I'm so glad that you brought that up, because you're correct in that no one else, until we spoke last week, no one else was really talking about the consequences to do that.
And the feds aren't saying anything about it, because they're not the ones that are going to be able to make those rules when it comes time. And this kind of leads me into the underwriting guidelines, right? Depending on how this all starts to shake out, the mortgage industry is going to look back and they're going to start making decisions going forward on how guidelines are going to look. I think that in large part, owner-occupied, non-owner-occupied, whatever, they're going to enhance guidelines. It's going to be a little bit harder to qualify for mortgages going forward. And in particular for the non-owner-occupied side, if everyone's taking advantage, maybe unnecessarily, of the forbearance, you need to be prepared that the new guidelines written are going to be reflective of how we handle it over here. There was another piece that I was going to tell you about that, Lindsay, and I've forgotten. It's going to have to come back to me. I'll hopefully.
What are your predictions, or just guesses, I guess, on additional guidelines and possible changes moving forward?
I would say more money down, probably. They're just going to enhance the down payment, maybe credit score. The reserves for the owner-occupied definitely are going to be there. Because if you think about some of the other things that have been going on that have been causing some of those defaults, the unemployment, for example, right? The people that qualified for those mortgages, they're not required to have any reserves. So if they lose their job, they don't even have a month worth of reserves to make the mortgage payment. It's a lot of those guys are paycheck to paycheck and they're already leveraged to the hilt. So, they're seeing some issues with underwriting guidelines related to first-time home buyers. And yeah, it's going to continue. I think that the guidelines, even before we get out of this, they're going to continue to restrict guidelines, especially for those Govy loans.
Yeah, man, and that's mainly, like you said, for the owner-occupant space, because after 2008, the investor space was already so heavily damaged, hit, changed, whatever word.
Yeah.
whatever word you want to say. So moving forward though, predictions, I mean, you guys are doing investor loans or, for investor clients primarily, but just moving forward, you know, we get asked a lot. So the biggest questions are the interest rate. How does this compare to 2008? And then when do you foresee us bouncing back, bouncing out, et cetera, et cetera. So just kind of your take on how we're going to come out of this, you know, especially given that the trend is going down, how we're going to come out on the lending side.
I do think that the guidelines will show a little bit, they're going to raise the bar a little bit. You know, as investors, because we're already putting so much skin in the game at the 20-25% down, 99% of the clients that we work with already have those 700 plus credit scores. And then the reserve requirements are already pretty harsh. I don't see too much changing to that right away. I'm keeping a very close eye on it. I'm hopeful that jumbo, I think that the jumbo will come back first of all the real big casualties that we've seen. Non-QM, if I had to guess, for those that need it for whatever their reason is, a year, maybe more. And then interest rates, you know, I had thought they'd start coming down before now. Mark Calabria, FHFA, he's the director of the FHFA. The liquidity or the facility that the Govy loans are getting for the servicers, because remember you guys, when a mortgage payment isn't made by us, the servicer, the company, the lender that bought the servicing rights to that loan still has to make that payment. The principal, interest, the tax, and insurance are still due to the note holder and to the county and insuring the property. So that money still has to go back out even if we're not making the payment. So the government, the Govy loans, they've created, the feds have created a liquidity facility to kind of bolster if they needed it on the servicing side. Mark Calabria came out and said that he doesn't think that the conventional Fannie Freddie is going to need that yet. And when he did that, I think it kind of, because we were seeing some improvement to rates just up until then, and I thought, and it was going to be a slower progression. I didn't think that they were just going to drop off the face like they did last time. But when he made that announcement, I kind of feel like the progression for improvement sort of just tapered off and we're kind of even keel. I think we got 30, 60 days probably. Okay, that's my best guess in terms of things starting to kind of really get steam. I don't think that this is going to trail off for years the way 08, 09 did. I think it'll be a much quicker recovery, maybe a little longer than I initially predicted, but I'm looking at July is where I'm thinking things are going to feel as close to normal. I don't know if they'll ever really feel normal again. This has been a defining moment, I think, in history for mankind. I mean, how could it not be? But July, I'll say July.
Yeah, I agree. This definitely has opened up some weak spots in how we can handle things, and it's just going to affect the way that we move forward in day to day. I'm very curious to see how this affects companies across the way in how they work remotely, et cetera. Just everything. It's going to be very interesting to see how all of that plays out.
You know, just real quick, it's interesting you bring that up because I'll tell you, in terms of real estate, residential, right? I don't think we're going to see too much restriction there. Values, I mean, maybe a little bit. Every market's going to be different, but commercially, for the reasons you just stated, Lindsay, I think for financing, I mean, all the way across the board, commercial is going to take a pretty big hit from this because I think that people are finding they were forced to kind of go out there and survive in those remote home or whatever spaces. They may not want to have to pay the expense of rent, institutional rent. So I think commercial is going to take a pretty big hit that way.
Yeah, I couldn't agree with you more. I mean, if you're able to close your office down and continue to do business as usual per se, you know, with all employees working remotely, then that is an additional cost that companies are going to, you know, kind of scratch their heads over, is whether or not they need to continue to do that. So yeah, I'm very curious about how that's gonna work. But that's all that I had. I really appreciate you taking the time and just kind of going over all of the changes. And I know that it's going to continue to change. and stuff. So hopefully you and I can circle back maybe in a few weeks or a month or so and just talk about any new developments, if that'd be all right.
You bet. And if you have questions in the meantime, let us know. I didn't mention about appraisals. This might be helpful real quick. Exterior appraisal only is what they're requiring. Fannie Freddie came out and gave us a little bit of a boon. We do not need interior inspection reports except on a cash out refinance. Any cash out refi, they still have to access the property, but otherwise they're letting us do drive-by appraisals and desktop appraisals. So that was...
Now, that's not lender specific, right? Because or when did this happen? When did that happen? Do you know?
It's probably been about 2 weeks that they made the announcement. This is straight Fannie Freddie agency guidelines that they put out saying that it's no longer required for them to insure, right? For the conservatorship to insure that loan, you don't have to have a full interior appraisal unless it's a cash out refi.
Yeah, that's good stuff. We've kind of we've had some that, and really we've had some appraisers push back because we heard that passed, and then we've had some appraisers actually give us pushback about, they're needing to go into the property. So, and we're having to say, no, I'm sorry, we're not going to allow that, especially if a tenant's already living there. We've just said no, that the liability is too great for us. Because we're not even allowing our maintenance crew to address non-emergency work orders. So it's, it's not really fair for an appraisal to go through. Right. But yeah, so that's the only speed bump that we've seen with that.
Yeah, and closings seem to be going just fine. We got simple signings is who we use, and there's a checklist that they give the borrower, and if they've they haven't been traveling outside the country and such. Anyway, gloves and masks and everything, but the signings are they seem to be going on just without a hitch.
Yeah, we have mobile notaries setting outside of people's houses in hazmat suits and to make sure that they get them closed. But now that's in most of investor purchases are done remotely anyway, so there's only been minimal changes to the day-to-day process there. So
yeah. Well, I'm here if you have questions. Thank you for having me. I appreciate it.
Yeah, thank you so much.
Okay.
Have a good one.
Thanks.